Cattle prices are still hovering near historic highs. Feeder cattle are sitting near $355, live cattle are holding near $238, and the U.S. cattle herd is one of the smallest we've seen in decades. On the surface, that sounds bullish. But the last time we had a setup like this, the cattle market didn't collapse. Feed cost exploded instead. Right now, corn is starting to move higher again. Crude oil just surged more than $4, and something else is happening that most producers aren't watching. The Pacific Ocean is quietly shifting away from La Niña conditions, and when that shift happens, the jet stream over North America often changes direction. Historically, those transitions have produced some of the most volatile growing seasons farmers experience. So the question this morning isn't just whether cattle stay strong. The real question is this: could a changing weather pattern trigger the next move in feed cost and cattle margins? Because if the pattern forming right now behaves the way it has before, the risk may not show up in cattle prices first. It may show up somewhere else. And we'll explain where that risk could appear in just a few minutes. Good morning and welcome to Boots Bushels, your daily look at the markets that feed America. Today we're mapping out pressure points using where futures were trading late Thursday afternoon. We'll start with cattle, move through grain and energy, and break down the developing weather pattern that could shape feed costs heading into planting season. And later in the episode, we'll come back to the question we just started with, whether a changing climate pattern could quietly shift cattle margins. Let's begin with feeder cattle. May feeder cattle were trading near $355.60 per hundredweight, down about $1.40. That's not a dramatic move, but when markets are sitting near historic highs, even small pullbacks start catching traders' attention. Feeder cattle have been one of the strongest markets in agriculture over the past year, driven largely by extremely tight supplies. Now look at live cattle. April live cattle were trading near $238.57, slightly higher on the day. So finished cattle remained very strong, even as feeder cattle softened slightly. When those two markets move in different directions, it sometimes signals pressure building somewhere in the supply chain. Right now, that pressure is likely showing up in feedlot margins. Feedlots have been paying historically high prices for feeder cattle, and that means they're extremely sensitive to changes in feed cost. Even a moderate rise in corn price can start tightening margins quickly. Corn futures moved higher again. May corn was trading near $4.53 per bushel, up about 9 cents. That may not sound dramatic, but for feedlots, corn prices are one of the biggest variables in cattle profitability. Corn makes up the majority of finishing rations. When corn starts moving higher, feedlots sometimes become more cautious about placing cattle at aggressive prices. If corn were to rally further during planting season, some feedlots could slow placements, which would ripple back into the feeder cattle demand. That's why traders often watch corn and feeder cattle markets together. When both start moving higher at the same time, margins can tighten quickly. Soybeans were also stronger. May soybeans were trading near $11.79 per bushel, up about 9 cents. Strength in soybeans is partly tied to weather concerns in South America. Brazil's growing season has seen uneven rainfall, and there are questions about how the country's second corn crop may develop. South America is one of the largest grain exporters in the world, so weather issues there can influence global supply expectations. When traders begin pricing in crop uncertainty, grain markets often respond quickly. Energy markets made one of the biggest moves of the day. Crude oil futures were trading near $78.87 per barrel, up more than $4. Energy prices affect agriculture in several ways. Higher crude oil tends to raise diesel fuel costs, fertilizer production costs, and transportation costs across the supply chain. When crude oil jumps this quickly, it can ripple into farming expenses across the country. For producers heading into planting season, higher energy prices can add pressure to already tight margins. Before we move into weather, a quick look at hogs. April lean hog futures were trading near $95.88, down about $1.20. So while cattle remain historically strong, hogs are showing a little more weakness. That divergence between livestock markets sometimes hints at shifts in consumer demand or feed economics. Now let's talk about weather, because this may become one of the most important stories in agriculture over the next few months. Several storm systems are expected to move across the Midwest and plains over the next week. These systems could bring thunderstorms, strong winds, and fluctuating temperatures across large parts of the country. Patterns like this often develop when the atmosphere begins shifting between climate phases. Right now, meteorologists are watching exactly that kind of transition. The global climate cycle known as El Niño Southern Oscillation is currently shifting. For the past several seasons, the Pacific Ocean has been under La Niña conditions. La Niña typically brings dry conditions to parts of the southern plains while pushing more storm activity toward the northern United States. but ocean temperatures in the Pacific are warming. Forecast models suggest we are moving toward neutral ENSO conditions sometime this spring. When that happens, the typical La Niña weather patterns begin weakening. Storm tracks can become less predictable. Rainfall distribution across the country often becomes uneven. Transition years between La Niña and neutral conditions are often some of the most volatile weather years farmers experience. The weather shift matters directly for cattle producers. Pasture growth depends heavily on spring rainfall. If moisture returns across the southern plains this spring, grass conditions could improve significantly. That would help stabilize hay supplies and support strong cattle placements. But if dryness returns, pasture stress could develop quickly. When grass production drops, ranchers often rely more heavily on stored feed. That can raise hay prices and increase pressure on cattle operations. Because the U.S. cattle herd is already extremely tight, even small weather problems can ripple through the market quickly. We've seen this kind of setup before. In several past years, when the Pacific shifted from La Nina toward neutral conditions, grain markets became volatile as weather patterns changed during planting season. Those shifts sometimes produce sharp rallies in feed cost. And when feed costs rise while cattle supplies remain tight, margins across the livestock sector can tighten quickly. That combination can lead to increased volatility in feeder cattle markets. So here's the answer to the question we started the episode with. The biggest risk right now may not be the cattle prices collapsing. Instead, the risk may be that a shifting weather pattern tightens feed costs at the same time cattle supplies remain extremely limited. If grain prices move higher while pasture conditions remain uncertain, the cattle market could become even more volatile heading into summer. That kind of environment can create both opportunity and risk for producers. So heading into the weekend, the cattle market remains historically strong. But strong markets don't eliminate risk, especially when feed costs, energy prices, and weather uncertainty are building underneath the surface. Because in agriculture, the biggest moves often begin when markets look calm on the screen. Thanks for joining me for Boots and Bushels, your daily look at the markets that feed America.